Craig Peckham, Managing Director, Equity Product Strategies at Jeff. Tom Lydon, ETF Trends Editor. Tom Lydon, let me ask you about this morning's trading. Okay, the long-term Treasury down again below 260 or thereabouts. Gold rising, materials rising. Is there a new trend in place? Because all that stuff got slammed, the commodities, last week. A new trend, a new week, a new day?
It is, Larry. Well, we've been, to a degree, in a trendless market so far this year. You know, we get above the 200-day average, we get below the 200-day average. Investors, to a degree, are checked out. You have to pick your spots. Everybody's looking for yield, so there's opportunities on the high yield side. Also in sovereign debt, some of these emerging market ETFs are doing great with emerging market sovereign debt bonds kicking in 4.5% yields. And then finally, you talk about metals. The miners are really doing well. Great earnings reports, and with gold at $1,200 an ounce, you're able to pull it out of the ground for $250. There's great profitability there. So if you pick your spots outside of domestic general markets, I think you're going to have great opportunities.
Craig, we're looking at light volume right now. It's likely only to get lighter for the rest of the summer, the rest of the month at least. Does that help or hurt if you're an investor? How do you play that?
Well, I think what that translates to is a marketplace that could wind up being relatively directionless. I mean, we've been in this roughly 1050 to 1150 trading range in the S&P since May. Not a whole lot on the horizon right now to sort of give one a lot of confidence of breaking out of that. You know, we do have a data stream coming up this week, which becomes increasingly skewed to the U.S. macro side, and specifically in the housing market overall. Those haven't necessarily been data points to lift the market's confidence in recent months. I don't expect a lot different today, particularly in the back of the NAHB number today, which was relatively disappointing. But you know, by and large, I think as we move into the quieter portion of the year, the quieter portion of the summer, it could give rise to a decent opportunity to add to some of the names that we think have decent yield support. A name we've been talking about a lot more lately is Pfizer, which has got more than twice the dividend yield of the S&P, and a name that actually has a fundamental catalyst coming up at the end of the month when we'll see some more data on apixaban, which is a relatively important drug for them.
Tom Lydon, gentlemen prefer bonds. Investors prefer bonds. And I want to ask you, look, at a 260 Treasury 10-year, and also corporate bonds have done extremely well with narrow spreads against Treasuries. Corporates indicate healthy profits and balance sheets. Don't stocks have a lot of value in this bond environment? The S&P is what, 8.5% forward earnings yield? I mean, the bond message, is that bullish or bearish for stocks?
Well, I think it's very bullish, Larry, and as you point out, balance sheets have improved. They look much better. But again, in order to get stocks from where they are today higher, we've got to get investor confidence up there. The M&A news is good. IPO, increased interest in IPOs is great. The fact that the Russell 3000 companies have almost $3 trillion on their balance sheets, that's fantastic. And we saw this same environment after the 2000 to 2002 bear market. In 03 and 04, all these activities start to ramp up, and the average investor wasn't engaged yet. But when they do get engaged, and I hope in the next couple of months we'll see that, it might be off to the races.
Craig, do you agree with that? I mean, if investors don't get engaged right now, are they in danger of missing the boat?
I think to some extent there's some truth to that, largely because what we're looking at right now is while the market may feel a little bit directionless on the aforementioned volumes that are relatively light, we are looking at a market that, especially after last week's pullback, certainly looks a lot more attractive from a valuation standpoint. You know, something you know, in the neighborhood of 11 to 12 times next year's numbers, historically a decent entry point. You know, an interesting paradigm or paradox has been brought up here, which is the corporate bond market appears to be telling a much more bullish picture than the Treasury market's telling us in a standalone. The Treasury market right now is telling us that we should expect a more sustained, even double dip kind of slowdown ahead of us. Yet the corporate bond market, as measured by spreads, is certainly getting tighter and outperforming equities on a very short-term basis. A tendency right now is to think that the corporate bond market probably has it right.
So, Tom, big question. Will a Republican sweep of the midterms liberate and rescue the stock market?
I hope so, Larry, and I think it will. I mean, we are geared up for a great November, and I think as long as everybody continues to keep their nose clean on the red side, everything should go well.
But why? Tell me why, okay? Tell me why. Besides the fact that you may like Republicans more than Democrats, tell me why a GOP sweep could rescue and liberate the stock market.
Well, you know, most importantly, from a tax standpoint, you know, we want to see lower taxes. We're really concerned about, you know, Obama taxes coming in 2011. And again, if they can be mediated to some degree, it's going to bode very, very well for the markets.
All right, guys, thanks so much for joining us.